Hey guys, so I've been thinking I would do more of a long form now to try to expand on where the market currently is here in Carlsbad, Encinitas, San Alejo Hills, as well as San Marcos, San Diego. And to go even further, an expansion of what the total narrative of the national market is. All right, so let's start with inventory, okay? So what we're seeing in our market is, yes, year over year inventory has increased. I'm not going to say substantially, but it has. We've went up over 1.3% of market of houses on the market available. And the other two metrics that are coming into play is, so price increase has gone up year over year. However, sales volume has decreased year over year. Well, that doesn't make any sense. Actually, it does. So what that means is the houses that are selling for more, right? But there's less of them that are selling. So there's a lot more expireds. Okay. What is an expired? An expired listing is something that goes live, has a contract, let's say for 6 months, 9 months, maybe even a year, and does not sell for the price requested for the home. Now, it really depends on the individual who's selling the house, right? What's their narrative? What is their intent to sell? Well, more often than not, we're seeing people outside of the investor pool. We're seeing people who want to sell and trade up, across, maybe down, to utilize the capital via equity that they have in their home, or they're moving out of state or out of area for that matter. So the people who listed their house, i.e., going back to the expireds, and they didn't get what they needed for the house, well, then they just let the listing expire and then they decided to stay in their home. They could afford their house. This wasn't a matter of like, I have to sell. It's, I want to, I would like to, but it only pencils at X. Now, what we have seen outside of that, though, is if something is priced, now granted, again, this is hyper local, this is specific to my surrounding area. A perfect example is San Marcos. So this property right here, San Marcos, it was listed well below market value, about 10% under market value. Well, what did that do? That created such a buzz that when they hosted their first open house, they had to have a person at the front door who is in charge of allowing people to come in, because otherwise, as soon as they opened the door, it would have been a flood and complete bedlam, and they didn't want that. So the individual who stood there at the door with their notepad, right? Everyone who is unrepresented, need your name, phone number, email address, and the people who did have representation. So I took one of my clients, for example, and and they made me give them a business card. Not a big deal, but nonetheless, that way they could circle back with everyone who came and viewed the home, right? There was no parking. This was in a little sub community, if you will, in San Marcos. So it was one block. It was all tract development. There was no parking on that block. The line, I showed up early before the open house even started, waiting on my client. The line came out the front door, down the walkway, down the driveway. We haven't seen stuff like that since the middle of COVID. Now, during COVID, granted, you had all the restrictions in place of, hey, mask, and got to have a reason to go out, and need your vaccination shot and all that. So that completely changed. People weren't doing anything other than, hey, the rates are 2.9%, I can afford now so many homes that I'm gonna go look at homes. So that plus the restrictions of like only so many people allowed in a home, so on and so forth. Anyways, since about October of 2022, we saw that obviously start to slow down, right? 2020 was crazy, 21 was crazy, 22 was still pretty crazy until about October. By then, the rates had jumped all the way up, almost to 8% at that point. And we just saw this like slowdown, major slowdown, of course. But the home prices were still increasing. Right? The home prices have continued to increase year over year. So all these gurus out here, all these wannabe influencers that are telling you, oh, we're headed for a crash, we're headed for a crash. No, we're not headed for a crash. Even the word correction, I wouldn't personally agree with. I would attest more to a stabilization of the market, right? Well, what does that mean? Okay, so we'll use a real life example. The house that I'm at right now, which I'll show you right here, it's been on the market for 34 days. Okay, so in Carlsbad, in San Diego, 34 days in comparison to where it's been, that's a lifetime, right? If something doesn't move typically the first week, then you're already talking about price reductions. Now, outlining markets aren't necessarily affected that way. So what I've seen now, I've only been licensed. I've been building since 2016 in California, but I've only been licensed since 2018. So when I got into the market, I saw that balance, like 90 days on the market was not abnormal in any capacity. That was like your average days on market. It was more of a buyer's market, but there wasn't this rush in the market, right? There wasn't this like, you know, oh, there's a housing shortage, blah, 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 which also makes no sense to me. Anyone out there who's telling you, oh, yes, we have a housing shortage in America, it's like, what happened? What happened? So, wait a minute. So, from 2018, when we had all this inventory, to when we had an affordability, like, boom, then all of a sudden we had this housing shortage. It's like, nothing. No, we didn't just populate by millions and millions of people over the span of 2 years. That's not it. No, we have a housing shortage because now so many people can afford homes and not enough people are selling their homes. That's the reality of what's happened. So, again, back to my point. If I were to say anything right now, we're headed to a new watermark. I personally don't believe that there's going to be a crash or a recession. I think we've avoided all of that potential. Do I feel like we were close to it? Yes. Do I feel like now it's this like softening and stabilization of, okay, houses aren't selling in a week at retail price. So what do we have to do? Well, you as Mr. or Mrs. Seller, if you want your house to have a bidding war, be sold quickly, then guess what? You need to do just like the property I mentioned earlier, list it 5 to maybe even 10% under market value. Because what's that going to do? That's going to create momentum. That's going to create attraction. People buy, right? Because they can. Like there's no magic equation here. Is it affordable? Is this the nicest house that I can afford at a cost that is most attractive to me? It's that simple. So as we see through the rest of this year, we'll kind of see this like stagnation, ceteris paribus. What does that mean? That means that if everything stays the same, like if our current commander-in-chief doesn't start doing crazy things, which we never know whether or not he will, but if he just kind of like cools his jets and we just kind of chug along right now, rates are going to stabilize. We've already baked the rates in. Everybody talks about, oh, they're going to lower the rates. They're going to lower the rates in September. Yes, they're going to lower the rates. But you know what they're going to do? They've already on the mortgage side, they've already baked that in. So what are the rates right now? Well, they're in the high sixes. Okay. Now, granted, that's national market. I'm not a lender, so I can't sit here and tell you like, oh, this is what rate you're going to get. No, that's national market. Your DTI is going to be factored in. Okay. Your credit scenario, your work history, like there's so many contributing factors before you'll even know what rate you qualify for. If you're in bad shape, you might still be at 8%. We don't know, right? You have to talk to a lender. So now, San Diego, I talked about local, hyper local. So let's talk about total market. All right. Again, where are you? What are you looking at? What paper are you reading? What news platform are you watching? What YouTube channel? What social media platform are you on? If you listen to certain people, they're saying, oh, this is 2008 all over again. No, it's not. There's not. We don't have the ticking time bomb of the ARMs. Okay, what are the ARMs? The ARMs were the adjustable rate mortgage that was put into play in the early 2000s, where home buying had kind of gone somewhat stagnant, and they needed to create new programs to incentivize people to buy more. So what do? Okay, we give them adjustable rate mortgages, ARM. All right, so you buy something, it's 2.9%, it's 3%, whatever it is. Well, that's only for the first, depending on when you bought, that was going to be a year, 2 years, 3 years, 5 years, whatever. But right around the same timeline, those ARMs started adjusting. And then all of a sudden you had this huge pool of people who couldn't afford anymore because the rates went up almost overnight, right? People started panicking, people started selling. And then you saw this huge crash. We are not there. A majority of homes are in some semblance of a 30-year fixed. Some people do a 15-year fixed. Some people still use ARMs, which doesn't typically make sense. In very small scenarios it might make sense, or some people might be using non-QM or hard money loans, right? You might need a bridge loan. We're not going to get into all the minutia of those details, but national market wise, Florida, they're struggling, but you have external factors. You had a tornado that came through. Not tornado, hurricane. I don't live in Florida. I don't know the local vernacular. So you had that, which affected insurance rates, right, on houses. Then you also have inflation to take into consideration. Most HOAs, they have to increase because their bills go up, which in turn makes your homeowner's insurance go up. And then the HOAs, the homeowners association, those bills go up too, because it's like their property taxes, they have a master plan in a complex, right? So it's like, hey, we have to pay the people who do the landscaping more. We have to pay a higher water bill for the community pool. We have to pay a higher maintenance bill. We have to pay a higher electric bill. Like, the inflation is creating the HOA to go up. It's not like these people at the HOA communities are going, we're going to get all kinds of money out of you. It's like, no, they have to stay solvent, right? They have bills to pay too. So Florida, if you look at it as a whole, it's like there's a lot of inventory. And don't take my word for it. Take 2 seconds, okay? And hop on Zillow right now and Google, or not Google, but Zillow, go from Google to Zillow, into Florida, and just look at the inventory on the market, right? Go to Cape Coral, go to, heck, even go to Miami, right? Like, basically anywhere in Florida, it's like you'll see a lot of homes for sale. So why is that affecting? Well, supply and demand. It's very, very, very simple economics. If you have a ton of supply and not as much demand, what is that going to do to the prices of said product? Inconsequential of what the product is. Okay, so if we have an abundance of Nike shoes, right? Like, let's just say there's an oversupply of Nike shoes. Well, if not as many people want the Nike shoes and they've already made all the Nike shoes, now you've got all this inventory, you got less demand. Well, guess what? They're going to have to start dropping the prices of the shoes in order to get them sold. Same concept as the house. Genius. But then you go into other areas. I know Georgia, Atlanta, it wasn't penciling out. I looked into that as well. There just wasn't, from an investor standpoint. I was looking at it from an investor standpoint, wanting to do a 1031 exchange. Didn't make sense. North Carolina, South Carolina, those are areas now. Those are kind of contingent because the base is supporting a lot of that. I know there's a lot of military presence, which VA lenders, and you've had a lot of development from bigger development companies who can afford to offset the cost by utilizing in-house financing so they can get their products sold faster and offer better rates than you can if you were to buy a resale home on the open market. I know I'm saying a lot, and hopefully a lot of this is tracking with you. But that's more like the East Coast. New York, I mean, it's New York. You're going to deal with New York things. Not saying that's a bad thing. It's just like, New York's expensive. Like, that's just, Jersey. And then you go into the Midwest. I know Nashville was having a little bit of trouble. They were another area where there was a boom. And that's another easy way to just kind of have a rule of thumb on what is the market doing. The areas, Phoenix, Vegas, parts of California, Texas, Florida, where they have an abundance of development, because you get these people who look at it, it's like, hey, we can make money here, so what are we going to do? We're going to get greedy, we're going to build, and it's going to last forever, and bam, it stops lasting forever. So then, prices start coming down. So wherever you see the biggest increase, you'll see the biggest fall as well. Outside of some kind of external factor, force majeure is what it's called. So force majeure is also known as an act of God. So if somebody, or not somebody, but if there's an area that's being developed and you have like a torrential downpour or a tornado or a hurricane or a fire, i.e. California, the Palisades, what is that going to do to California? So that was something that really messed up California for the fire insurance company. So what a lot of Californians have to do is they have to buy with the Cal Fire, which is a supplemental fire insurance. It's guaranteeing that people can still purchase a home, because when you have a mortgage, you have to have insurance, right? It's just like a car. So when you finance a car, you have to have full coverage. Now, if you own the car outright, legally to be on the road, you have to have insurance, but you can buy like nominal insurance. Well, with homes, if you have a mortgage, you have to have insurance, right? And you can have a higher deductible, which will make your insurance cheaper, but then it's also more of a risk. Now, if you own a home outright, you actually don't have to have insurance on it. Is that an unwise strategy? 100%, because God forbid something happens, somebody gets hurt on your property. Well, you need homeowners insurance to cover that person if they break their foot or whatever, right? And also, like, if you ever get robbed, if something ever happens to the house, you want to have insurance, but technically you don't have to. So punchline, are we headed towards a crash? No. Are we headed towards a correction? It's like correction / stabilization. So if you base it off of a number standpoint alone, it's the months of supply of inventory that you have that the attrition or the sale, how long it would take to get rid of that inventory, depicts whether we're in a seller's market, buyer's market, or a balanced market. So right now, if you base it off of that, we're technically in a balanced market. However, for the most part, we're seeing more and more sellers give closing costs, which a good rule of thumb, if you have a conventional loan, you can get about 3% covered. That's your reoccurring, non-reoccurring costs, okay? So that can help offset that cash to close. It cannot help with the down payment. Down payment is still on the buyer. Now, there's also supplemental programs that you can work with that will help offset that too, but it depends on your scenario, right? You may do something that sounds great and you have the idea of, oh, hey, I'm gonna live here for forever. This is my forever home. Every time I've heard somebody say this is my forever home, guess what? They moved. So I just, words of the wise, most likely not gonna be your forever home. So if you're gonna buy right now, it's all about the strategy. This is a market where it's like you want to buy because it's a good financial investment and you're in a position where you've saved up for the down payment. You are confident about your monthlies because yes, year over year, over time, you are going to win out. But make sure it's something that you want to live into for a minimum of 3 years. Minimum, right? And the longer you hold that property, the higher appreciation long-term you will have. And then down the road, that's when you get to decide, do I want to keep it as a rental? Do I want to sell it, utilize the equity or appreciation that I have on this house or the updates I've done that's, increase the equity of the home by a sweat equity and sell, buy something new, relocate, leave it to my kids, leave it to my family, whatever your game plan is. But that is a really long explanation of what's really going on in the market, coming from a licensed real estate agent who I host open houses pretty much every weekend. I see the people who walk through the door. I hear the conversations. I can tell you 100% boots on the ground. I help the people who are getting qualified, what they qualify for. Right now, I just helped a couple the other day. One's an engineer, one's a doctor, right? Granted, we're in San Diego where you pay the sunshine tax, but combined, they're well over $200,000 a year. You know what they could afford comfortably? About a $500,000 house. Now, again, that's because they were taking into consideration the homeowner's insurance, right, as well as the HOA. So they were only looking at homes that were townhomes, condos, in some form of HOA. So your monthlies they compound real quick, right? Now, if you're going to get a single family res, well, and you're at the $1 million price point, it's like, will you qualify if you make $250,000 a year in gross revenue? Yes. Will you feel comfortable at that price point? I don't know. I don't know your situation, right? I don't know if you have some kind of supplemental income or you've saved enough to put enough down to where that is going to be comfortable for you. I don't know if any of this helped. Hopefully it did. If you're looking for more information, please give me a like and subscribe. And I'm here to help out if there's other markets you want to hear about in California or outside of California. I'm happy to do. I'm part of Compass Brokerage and we are nationwide. I can always set up a Zoom meeting and talk with areas that you're interested in, albeit wherever, Nashville, Idaho, you name it, right? I'm happy to help. All right, guys, I hope that was helpful and I hope to see you on the next one. And remember, it's not what you do, but how you do it with quality. I'll see you on the next one.